Most people approach prediction markets like it's a final exam. They think the only question is whether the contract settles yes or no. Will this candidate win? Will the team make the playoffs? Will the Feds cut rates? And will this particular event happen by a certain date? But sometimes the sharper play is not about holding until the final outcome. It is about understanding when the market will reprice before the outcome is even known. And that is where prediction markets start to look less like gambling and a bit more like trading. You do not always need to be right at settlement. You need to understand when attention, uncertainty, news, and emotion will move the price enough to create an exit. A contract trading at 28 cents does not have to settle at $1 for you to make money. If new information, media momentum, public panic, or a key event pushes it to 43 cents, there may already be value in cashing out. The win is not about being right forever. The win is recognizing that the market was underpricing the next wave of belief. You can clearly see this most in soccer markets, where the possibility of a draw changes the entire structure of the trade. In a traditional sports book, you are usually forced to pick a side, a draw, or some derivative of that outcome. But in a prediction market, if Team A and Team B are listed as separate yes-no contracts, the trader can take no on both teams to win. And this is where it gets really interesting. If the match ends in a draw, both no contracts can benefit. But even if the game does not end in a draw, the structure creates an unusual kind of upside. For example, let's say Team A wins the game. The no on Team B still wins. If Team B wins the game, the no on Team A still wins. You are not necessarily trying to predict the exact final score or marry yourself to one side. You are playing the shape of the market. Pricing is each outcome and the fact that soccer has a third result hiding in plain sight. That does not mean that the trade is automatically profitable. Price still matters. If both no contracts are too expensive, the math can erase the edge. But when the market misprices the draw risk or overstates the likelihood of either team winning cleanly, the middle ground becomes the opportunity. This is especially important in markets where the final result is so far away. Elections, awards, playoff futures, regulatory decisions, injury-dependent sports outcomes, and economic announcements can all swing dramatically before they settle. The market may move because reality changed, but it also may move because perception changed. In prediction markets, perception has a price tag. That means the question becomes different. Instead of asking, will this happen? The better question may be, is this contract likely to become more believable before it is settled? And that is a completely different skill set. It rewards timing, narrative awareness, liquidity awareness, and emotional discipline. It also requires knowing when to leave. Many traders turn profitable positions into losses because they fall in love with being right. They had the cash out window, but they ignored it. The smartest prediction market players understand that the exit is part of the strategy. And sometimes the best trade is not writing the contract to resolution. It's catching the repricing, taking a profit, and letting someone else argue with destiny.